For today's first Spotlight conversation, Best Ideas, the Next Opportunity in Private Credit, please welcome Victor Khosla, founder and CIO, Strategic Value Partners, and moderator Matt Schifrin, executive editor, Forbes.
Hi.
Victor, before we dive into the next opportunities in credit, tell us a little bit about Strategic Value Partners.
Matt, just a pleasure being here with you. We've got $22 billion in assets under management. As a firm, we got our start in distressed debt and restructurings 25 years ago. And then, over time, we built the firm brick by brick. So the Strategic Value Partners of today, we have the ability to buy debt, take control of businesses, fix businesses, improve businesses. We buy real assets like airplanes and power plants and real estate. And when we buy real assets, we have the operating capabilities to truly work with them, grip them, improve them. And sure, distressed is interesting 2 years out of 10, but my gosh, it's a cyclical business. One last thought about us, Matt. We are a US-Europe firm. 60% United States, 40% Europe. And for us, when you take it all together in opportunistic credit, we as a firm are really an all-weather firm rather than a boom-bust, distressed, or super opportunistic credit investor.
Thanks, Victor. So before we heard a lot about American exceptionalism, but on our prep call, you said that things are much worse under the surface than they appear. Can you explain to the audience what you're talking about?
Yeah, look, these headline markets are fine. Even after the up and down of this last 4 months, right? Equity markets in the US are still up a little bit. High yield spreads are still pretty tight at about 340 basis points to treasuries. So on the face of it, it looks like, hey, things are okay, right? Under the surface, default rates in high yield are 5%. 5%. In COVID, they were 6.5%. In the GFC, they were 12%. So what is happening is, away from what you see, you truly have a bifurcated market. One side of it, which you see in the headlines, looks okay. But underneath the defaults, the problems, they have been accumulating since, especially in the last 5-6 years, and those problems are really hurting. They're really hitting.
So I assume that means that prices are down for credit. Where are the opportunities? Are there sectors, regions? Where are you finding opportunities in credit?
Matt, can I go back one
Sure.
if I could? I just want you to appreciate kind of what's going on here, right? So you have, look, private equity is stuck. Private equity has not been able to monetize, not been able to realize assets. First you had COVID, can't sell with uncertainty. After COVID, you had the Fed hiking rates, can't sell again. With a lot of policy volatility in the last 4 months, can't sell again. And all this, by the way, what happens to private equity is they can amend and extend these deals. So that's a French term, right? Amend and extend these deals. But what happens is the $1 billion of debt they took on becomes like $1.3 billion after amend and extends. And they did these deals when rates were 0%. Rates today are no longer zero. And as a result of that, you've got a reckoning. You literally have a reckoning in the private equity world now, just where we are. Where are the opportunities?
Yes, where are the bargains?
Yeah. Look, when you look at kind of all these old private equity deals, Just look at all of them with larger and larger amounts of debt. By the way, something pernicious happens when you're in that world, right? The good management teams leave. They say, hey, my MIP isn't worth quite that much. So it's not just like the capital structure problem. It's the good management teams are leaving, and what you have is businesses which are increasingly, even operationally, starting to run down. Look, we look across today, these old private equity deals, half the private equity portfolio is 5+ years old now, right?
Yep.
You just look all across industrials, building materials, consumer brands, business services, look all across. By the way, look at Europe. Europe has struggled more. They've just been in a malaise for the last 4 or 5 years compared to the United States. In Europe, those problems are even more intense. And look, and what we would tell you is that there's $5 trillion of high-yield debt out there, 26,000 companies in the private equity portfolio. And even away from this, there's $8 trillion in commercial mortgage debt. And commercial mortgage debt, there's a slow-moving tsunami making its kind of way through. And that's kind of what the opportunity set is.
So there's a lack of buyers. Are there any particular parts of real estate where you're finding bargains?
Matt, it's not so much, forgive me, right? It's not even that there is kind of a lack of buyers. A lot of this stuff, this is not kind of traded debt, which comes on your Bloomberg screen, and you're like, oh, that's a great 60-cent bond, or that's a great 55-cent piece of paper. When you make these investments, you've got to be willing to step in and improve operations and fix some of these businesses. This is not a traded debt opportunity, what we see today, right? In this 5%.
Private deals.
Yeah, and you need real skills to kind of work it out. You just can't be the 2008 trading guy who just says, hey, I'm just picking and choosing which ones to buy. Very different. How you prosecute this opportunity, very different.
So if there's this big looming problem with debt, does that mean we're more likely to be in a recession? Is a recession coming?
No, actually, the funny part with this, Matt, all this coexists with a sort of an okay economy and good stock markets, right? It's not, look, please, I'm not here trying to tell you, oh my God, the world's going to end, there's going to be a recession. In fact, our base case, we really don't think there is our base case is the US economy is so flexible and resilient, there isn't a recession. So it's really these two things coexisting with each other, right? Whether it's not like, please, we don't think there's some big systemic issue or something. There isn't. What it is this huge swath of opportunities in these credits, whether it's corporate, whether it is real estate, and it's going to take 3-4 years to kind of work our way through it.
Really quickly, you have some interesting portfolio holdings. You have a Hornblower Ferry, which owns New York City Ferry.
Yeah.
You own a toll road in Texas. Give us a quick rundown on how you find great credits.
Yeah, when the Hornblower opportunity, so we own a business which has the Statue of Liberty Ferry, the Niagara Falls Ferry. Interesting business, long-term contracts. The toll road you're describing, we own a toll road where we bought debt and converted it into equity. Mm-hmm. And this is the claim to fame of this toll road between Austin and San Antonio is that you can drive 85 miles an hour. That's the speed limit, right? The highest speed limit in the United States. The way we source these deals, these are infrastructure deals. If they were all wonderfully packaged up, your sovereign fund, your big pension fund, which buys infra, would bid for these assets at a 7%, 8%, 9% return on capital. Very competitive if you're trying to buy it like that. For us, the way we buy them through the debt, SH-130 had $1.6 billion of debt. It was syndicated out to about 10 banks, mostly in Spain, by the way. Right? This is a deal in Texas where the bank debt is owned by Spanish banks in Spain. And the way we kind of bought into it was buying it from the Spanish banks piece by piece. Took us about a year and a half to accumulate it. If you do what we do, you don't want to be the person who goes and buys this once it's all kind of together and nicely, prettily packaged up. You buy it piece by piece. And look, this investment has just really worked out very well for us. Elon Musk, Tesla Gigafactory. In our ownership of this road, he put his Gigafactory right on our toll road.
Highway.
Right? Go, Elon.
Great.
Yeah.
Well, thank you so much, Victor, and thank you, guys.
Thank you very much.
Yep.
Thanks, Matt. Thank you.